Hey, it's October 23rd, the market update desk, Scott Riley and Mortgage One. We had some interesting stuff happening overnight this morning and actually late this afternoon, which is affecting the bond market and stock market. So I wanted to run through that, give you an idea of the forces that are in play today. The last one I'll cover is actually potentially a positive effect, what will happen for mortgage rates. So stocks and bonds started the day out lower this week. The 10-year bond actually hit and surpassed the 5% barrier on the 10-year treasury. So that was significantly concerning. But the Bank of Japan last night came out and said they may make another adjustment to their yield curve control at the end of the month and allow the 10-year equivalent to rise further. As a result, the Japanese 10-year has moved up 0.88%, which pressured European yields higher. The German 10-year rose to 3%, a level not seen since 2011, while the Italian 10-year rose to 5%, the highest it's been since 2012. The good news for our bond market is that a 5% rate on the 10-year yield starts to become very attractive for bond investors, and we could start to see some international demand come back in because of these changes with the European, the German, the Japanese bond markets and currency control. So that is a positive move potentially because we've had unbelievable surplus of bond sales. We need investors, buyers, both domestically and internationally, to come back into the market. So, what happened late this afternoon is Bill Aukman, who is the CEO of Citadel Funding, came out and said Pershing Capital, came out and said he's closing out his shorts on the 10-year treasury, citing too much risk. And Bill Aukman's a very big voice when it comes to the world of investings and specifically bonds. So him closing out his position on the bond market, let's hope that might just pretend that further investors start to close out their short positions too in the bond market, because the shorts have been really taking it to us in the bond market. If we can get some relief from that, we might be able to claw back a lot of these losses we've had over the last 6 weeks. So that's a very positive direction that we might just have. A report from Fitch, a rating agency, reported that delinquencies on auto loans that were 60 days or more past due increased 6.11%, the highest level on record. So there's developments on the weakening of economy, not the strength. And it's one more thing maybe to show the Fed that it's not as strong as they are interpreting it to be. Redfin reported that listings were up last month 1.4%, which is the largest inventory buildup since February last year. Now, keep in mind, this is one of the biggest times of year that we see an uptick in listings because kids are back in school, parents aren't looking at houses as much. Then as we go through to the spring market, it starts to go up again. So this is a seasonally normal thing. What does that mean for buyers? Now's the time to buy. That's what it comes down to. The seasonally adjusted increase in listings could help you get a house where you've been fighting so hard to get one. It may be the best time right now to do that. Inventories are, like I said, inventories are still near record lows. And Redfin also reported that almost 40% of the homes all of the homes under contract listed went under contract in September. So the inventory that's out there, granted it's slightly more than what we've seen in the last 4 or 5 months, is still being gobbled up very quickly by buyers, meaning that the market still has significant appetite for business. So as buyers, trying to get ahead of the curve of all these multiple offers is in your best interest. For sellers, you have still a significant number of buyers that want to buy your home. What do we got coming up this week? It is a very important week with multiple different data reports coming out. Wednesday, we have new home sales. Thursday, we have the first quarter reading on Q3 or quarter 3 GDP. it's going to be very, very interesting to see how the economy grew and was affected by a lot of different national and international issues that are going on. Also, pending home sales is coming out. And Thursday also is jobless claims, which have not been our friend in the bond market lately. Friday, the Fed's favorite measure of inflation, PCE, personal consumption expenditure. So hold on to your hats. I'm hoping for a slight improvement every day or for the week. We've been having these violent ups and downs for the last 6 weeks. It would be nice just to see a steady betterment in the mortgage-backed securities and 10-year treasuries rather than these violent upswings and downswings. With the bond market up where it is, mortgage-backed securities have just gotten hit hard. Mortgage rates are definitely elevated, but businesses still very, very busy. Today, mortgage-backed securities are up 18 basis points as we're talking. 10-year treasury, as I mentioned before, bounced off the 5% level that it hit early this morning and has come down to 4.84. So that's a significant decrease from where we hit in pre-market trading. All in all, I think it's going to be a positive week, and I am encouraged by some of the things that are happening in the bond market with covering some shorts, some positive information potentially Friday coming out with personal consumption expenditures. So give us a call. We can run through loan scenarios with you, give you loan options, help put our knowledge and strength to work for you. Give us a call, Scott Riley, 616-293-2189, and let us help you.